Okay, let us look at financial statements. This is one of the key areas that will be examined, especially in business paper 2. So first of all, when you're talking about financial statements, we are looking at accounting. So we are looking at the financial position of a business. So for us to determine financial position of a business or the status of a business, we have to prepare 3 documents. One of the documents is a balance sheet, trading account, and then profit and loss account. So let us use this question as an example to help us know how we can tackle financial statement. So the question goes, the following trial balance was extracted from the books of Njoroge traders as at 31st December 2017. So we have opening stock, which is 30,000, purchases stroke sales. Whenever you see purchases written stroke sales, what will appear on the debit side, that is purchases. But what will appear on the credit side, in the trial balance, that is what we call sales. So when you see like purchases stroke sales, it means 275 will be purchases, while 390 will be sales. 390,000 will be sales. Move to debtors. Debtors is 47,000. Now, as we move down, it's important to know that debtors, it is a current asset. And then we have commission received. Commission received is 36,000. It is revenue. Then we have returns. Whenever you see this word returns, and this is written a trial balance, returns, and they have given you amount on the debit side and you have amount on the credit side, you should know that the amount, this 10,000, the amount we have on the debit side, this will be returned inwards. That will be returned inwards. It will be returned inwards. But the amount written on the credit side, which is credited, this will be returned outwards. They don't have to tell, an examiner will not tell you. Examiner will not tell you that this is the return inwards, this is return outwards. You might just be given like that. Just given like that. So if you find the amount that will be debited, that is return inwards. And the one that will be credited, that's return outwards. Now, when you talk about return inwards, these are goods. Return inwards. These are goods returned by the customers. You might sell, a business might sell goods to the customers. And then maybe the customer finds that the goods maybe have gone bad if they are perishable, or alternatively, they are not the goods he or she wanted. So we'll return to the customers. And therefore, return inwards will be subtracted from sales to get net sales when preparing trading profit and loss account. While return outwards, these are goods which have been brought into the business, but now the business decides to return them to suppliers. So they'll be subtracted from purchases. Okay, we come to carriage inwards. When you talk about carriage inwards, this is the cost incurred by the business while bringing goods into the business. So when you incur some cost in terms of transport, that is what we call carriage inward. We move to bad debts. Bad debts, these are, the business might sell goods on credit. So just sell goods on credit. So these debts, maybe there's no possibility that they'll be paid by the debtor. So these are what we call bad debts. And now these bad debts, they cannot be used. When you see bad debts cannot be used when preparing trading profit and loss account, but instead they will be used when preparing a balance sheet, and it will be treated as a current. It will be treated as a current asset. Move to wages. Wages is an expense, so it will appear in profit and loss account. So we have wages of 20,000. We have rates 12,000. Then here we have buildings 450. And then we have furniture 180,000. So we have buildings 450,000 and then furniture 180,000. Now these two, furniture and buildings, these are fixed assets, and therefore they will be used when preparing a balance sheet. Then you have bank overdraft. What do you mean by bank overdraft? One might be, for example, if you have a bank account And then it happens that you go to the bank with an interest of maybe getting a loan. Then you maybe get money more than what you have in your account. So the amount you get more than what you have in your account, that is called bank overdraft. Then we have insurance. Insurance is an expense, will be used when preparing profit and loss account. And then we have discounts. Here, when you see they have written for you discounts as a student, you see discount here, discounts, but they haven't told which one is discount received, which one is allowed. So the amount that will appear on the debit side, the amount that will appear on the debit side, that is what we call discount allowed. While this one, 7,000, that is appearing on the credit side, that is discount received. Note that the amount that will appear on the debit side is discount allowed. On the credit side will be discount received. Now we move to drawings. Drawings will be 25, given us 25,000. It's important to know that drawings will not be used in trading profit and loss account, but instead drawings will be used when preparing a balance sheet. And what is the effect of drawings? Drawings reduces capital. It's important to know that drawings reduces capital. Among the adjustments on capital, we have 4 adjustments. One, we have drawings that reduces capital. So drawings is subtracted from capital. Another thing, we have net profit. Net profit increases capital, and therefore it is added on capital. Another one that we have is net loss. Net loss will also reduce capital. And then we have additional investments. So when you make additional investments, will also increase capital. Then we have cash at bank. We have creditors. First, creditors here we have 52,000. So creditors is a current liability. So when you look at this trial balance, we have 2 current liabilities. One, we have this bank overdraft, which is 210,000, and then we have cash. We have creditors, which is 52,000. But when you look at the 2, that is cash at bank and cash in hand, cash at bank and cash at bank, cash at bank and cash at hand. We talk about cash at hand is the money that the business have in the business. That's cash at hand. But then cash at bank is the money in the bank account that belongs to the business. Now, this will also form what we call current assets. Current assets will form what you call current assets. Now we have the last one, which is capital, which is 689,000. So I was just looking at the trial balance and seeing what details we have been given or the particulars. Now it's important that a trial balance must balance, and if you look at our trial balance, it is balancing at 1,390,000, both on the credit and the debit side. Now let us look at the additional information. The question has additional information. Additional information is very important. For example, we have closing stock. So at the end of the business, or the trading period, this business remained, or Njoroge traders remained with 50,000. And then we look at another thing, which is carriage outwards. Carriage outwards, let me use an example. Like, for example, if let us say a business happens to pick goods, to go and buy goods from a particular supplier, then the supplier decides that let us transport these goods to where they are required, or to the business or the premise where the business occurs. So now the supplier will assume that he or she is incurring cost to transport these particular goods to his or her customer, or to that particular business. Another example could be, for example, a business. Let us make an example of a business that maybe sells sofa sets. Yeah, sofa sets, the seats now. So now this particular business decides that, for example, if a customer buys, for example, a sofa set maybe worth 100,000, then it means that then here that particular business tells the customer that we are going to transport these goods, the sofa set, for you up to your place. So now the business will assume that they have incurred, or it has incurred, a certain cost to ensure that the sofa set reaches the customer's premises. So that is still what we call an expense. So the business will assume that we have incurred an expense. If we happen to look at, maybe we go deeper into accounting, we look at that is called operating cost. So that is still an expense. Okay, and then now the question comes here. Oh, two things before I move to the working. It's important to know that this closing stock will be used twice. It will be used in preparing trading profit and loss account, and it will also be used when we come to balance sheet, whereby it will be assumed that it is a current asset. It's important to know that closing stock will be used twice. Closing stock will be used when preparing profit, the trading profit and loss account, and will also be used in a balance sheet to determine the status of the business, but as a current asset. Now we go to the question. The requirement is that prepare Njoroge traders trading profit and loss account for the period ended 31st December 2017 and a balance sheet as at that date. When you're asked such a question, it means that this particular trading profit and loss account will determine how your balance sheet will look. So now let us move to working. Let us move to the working now. Now when we move to the working, we first, when you're preparing trading profit and loss account, the first thing you have to do is to come up with the name of the business, and you have been given. The name of business, you not get it anywhere. You get it from the question. So it was Njoroge Traders. And then you indicate, this is what you call financial statement. The name of the account you're preparing, which is called trading profit and loss account. That's why I'm indicating here that it is trading profit and loss account. Let me just indicate it for you. That is trading profit and loss account. It is there. It is there, trading profit and loss account. Then for the period, you show us which is that period. That's what it's saying, for the period ended 31st December 2021. Or you can use the word for the period ending. It's still the same. Period ending 31st December 2021. So now after that, you have to draw a line and then divide into two. When you're dividing into two, the side you'll deal with what has come, what the goods in the business, and then you deal with what you call the sales. And remember, while you're preparing this, our aim is to determine what you call GP, or the gross profit. Gross profit is equals to sales minus the COGS. So COGS stands for cost of goods available for sale. Okay, let us start preparing trading profit and loss account. So here, the heading is very important. The heading is very important. It earns a student a mark. So we start with opening stock. So when you are indicating opening stock, is the one we have, which was 30,000 from the trial balance. So now, first when you're writing this opening stock, you don't write at the middle. You don't write here. You don't write where. You don't write the first column of the shillings. No, you write at the farthest end, the end, meaning that the opening stock is there when we are starting our business. So now anything we bring into the business will increase the opening stock. So here this business purchased goods worth 275,000. So 275,000 will be put on the first column of the shilling column here. This shilling column here. It shows the currency we are dealing with. And then we talk about add carriage in. So carriage in is 16,000. So here I have to take first add purchases and add carriage in. I said carriage in is the cost incurred when bringing goods into the business. So you take 275,000 plus 16,000. And then you less return outwards. I said return outwards are goods that maybe the business does not need. So therefore, they return them to the supplier. That's what you mean by less return outwards. So it's important to indicate that it is less return outwards, like that, return outwards. So 6,000. So we are taking 275,000, then add 16,000, which is the cost incurred when bring goods in the business. That is like transport, and then less 6,000. And then after that, you underline. When we are underlining, the way I've underlined here, it shows that we are either adding or subtracting. We are showing the effect on the details that are put there. So therefore, when you take 275 plus 16,000 minus 6,000, we get 285,000. So now this 285,000 we add with the opening stock, we get 315,000. This 315,000, it is what we call GAS. GAS stands for goods available for sale. And then we less closing stock. Now closing stock, it means that this is the stock that remained unsold in that particular business. So therefore, we less closing stock, which is 50,000. 50,000 is what you are given in additional information. Remember that? Then we get what you call COGS. So when you take 315 minus 50,000, we get 265,000. This 265,000 stands for COGS. COGS is cost of goods sold. Now, as I told you that gross profit is calculated by sales minus COGS. Okay, we have done the side, the right hand side, and we got the left hand side, and we got our COGS. So we go to the left hand side where we look at sales. How much do you have in terms of sales? Sales we are given in the trial manner as 390,000. And then these sales will less return inwards. Remember, I said that return inwards, that these are goods that after being sold, they were returned. They were sold and then returned to the business. And therefore, they will affect sales. When you have made, so this particular business made sales amounting to 390,000. But then the customer felt that a part of the goods were not the ones he or she needed, and therefore returned to the business. So therefore, return inwards are subtracted from sales to get what you call net sales. That's why I took 390,000 minus 10,000 to get 380,000. Okay, remember we got our COGS as 265 and then net sales as 380,000. Now it's important that we need to get GP. And I say that GP is equals to sales minus COGS. So now the difference between 380,000 minus the difference between 380,000 and 265,000, it is 115,000. That's what I've indicated. So that's why we are saying that now the difference between 380,000 and 265, it is 115. So it means that this business was making a profit. So now for us to ensure that our trading, the first bit, what I've done is what you call trading. Trading. We have not gone to profit and loss account. So trading, to ensure that 380 balances with 380 on the other side, we have to add 115, which was our difference, to 265, and then we get 380. So therefore, 380 ensures that it balances. So now it means that this business made a profit. Whenever you see that sales are more than COGS, it means the business made a profit. I repeat, whenever you see that sales are more than COGS, COGS stands for cost of goods sold, and then it means the business was making a profit. So the difference is what I placed here and stands for gross profit carried down, which will be, that is 115. So 115, when you add it to 265, you get 380. So now at that point, we have prepared what we call trading account. It's what we call trading account. Now, since I carried 115 to add 265 to balance both sides. It then means that after you have done that, after you underscore, and when I mean to underscore, it is these two lines here, it's the other side, So these two lines shows that we have balanced our trading account, and therefore the amount you indicated as gross profit carried down, you bring it down under the two lines, which means to underscore the two lines, and then you indicate as gross profit brought down. I repeat, the amount that you indicated as gross profit carried down to ensure that your trading account balances is the amount you bring here. You bring under 380, but on the sell side, as 115, but you indicate as gross profit brought down. Now we move to, after that, what we have simply prepared is what we call trading account. Trading account ends by you obtaining either gross profit or gross loss. But for this case, we obtained what you call gross profit, meaning that this business is made a profit. Okay, now we move to now what I'm beginning to prepare is what we call profit and loss account. So there's a possibility that we are either going to get profit or either going to get a loss. Okay, now this side that we look at the left hand side, we shall deal with wages. Left hand side will have the expenses. So expenses, we begin with wages, and then the right hand side we shall deal with revenues. Now it's important to note that the gross profit we got, it is part of revenue, so we'll include anything that we get as revenue that is appearing on the trial balance will also be added to the gross profit. Gross profit is revenue. So this side, from a trial balance, we had wages as expense, and then rates as expense. Now rates, these are payments you make. For example, if you own land, you pay rates. Now wages, these are this income paid to maybe people working within a very short period of time, like 2 weeks, those are wages. But when it goes to monthly, those now become salaries. Then we have insurance. These are cover taken. So when we talk about insurance, it's a contract between an insurer and insured. Not necessary here, but just know that if you take an insurance cover, that's an expense. Then we have discount allowed. Discount allowed. What do you talk about discount? Discount allowed is that, for example, a certain business might tell its debtors that we are giving you goods on credit, but if you pay within a certain period of time, we shall allow you a discount. So the business assumes that it is making an expense. That's why we are saying discount allowed will be treated as an expense, which is 5,000. And then we come to carriage outwards. Carriage outwards, as I told you, is that we assume that if customers have bought goods and goods are transported to their premise or where they are required, the business assumes that it has incurred a cost. And therefore, carriage outward will be treated as an expense. So now expenses are wages, rents, insurance, discount allowed, and then carriage outwards. But when you come to the side of revenues, the right hand, we have revenues. So our gross profit that we got from trading account, we will apply it when preparing profit and loss account. And therefore, we have these gross profit, then we add commission received, and then we add discount received. Now, discount received, this is discount given to a business by suppliers. People give you goods. So they give you goods on credit, and then if you sell and pay within a certain duration of time that you have agreed, they will give you what you call a discount. So therefore, the business will receive. That's why we call it discount received. Now, if you happen to add 20,000 plus 12,000, you add 20, you add 12,000, then you add 19,000, then you add 5,000, then you add 8,000. What you will get when you add all this, when you got 20, so 20 plus 12,000, this goes to 32,000. 2,000 plus 19, 2,000 plus 19,000, 19,000, and then you add plus 5,000, you add plus 8,000. That one will come to a total of 64,000. So 20,000 plus 12,000 plus 19,000 plus 5,000 plus 8,000 will come to 64,000. Okay, when you look at 115,000 plus 36,000 plus 7,000, it will come to 158,000. Now the difference between 158,000 and 64,000, it is 94. So it means that still now that business has made what you call a net profit. Remember, when we are preparing trading account, we will end at what you call gross profit or gross loss. But when you are preparing a profit and loss account, we will end at what you call a net profit or net loss. That is the change, net profit or net loss. So here, when we look at we look here. Now we got all our expenses as 64,000, while our revenues amounted to 158,000. Now, for us to be able to balance between now to get the difference between revenues and expenses, which means that this business is making a profit. What we'll do, we simply take revenues 158,000 minus 64,000, we get 94,000. So now this 94,000, you write it on our left-hand side as net profit carried down, that difference between 158,000 and 94,000. So you get what we call net profit carried down. So if you add to what we previously got in terms of expenses as 64,000, we will get, it will balance at 158,000, and then the same as wages as 158,000. So after that, you remember that I said that after that, the amount that you got as net profit carried down, which is the difference between revenues and expenses. Now you bring it down after having balanced, you bring it down and write it here, the way I've indicated as net profit brought down to be 94,000. At that point, what we have prepared is what you call profit and loss account. So it means the instructions were prepare profit and loss account, trading profit and loss account. And I said, from here, how I've highlighted this highlight from here, from there, from gross profit up to where I got the net profit brought down, that what we are preparing is what we call profit and loss account. But when we move from gross profit here, we move up here, and then we look at what you have prepared up to, what you have prepared from here up to here. This is what you call trading account. Trading account. It's important to know that you can prepare trading account separately with profit and loss account separately. But now for this case, we have decided to prepare trading profit and loss account according to the instructions. So now we combine them together, we call it trading profit and loss account. So we have finished working it out by getting our net profit brought down as 94,000. Okay, another instructions, when we move up, we were instructed also to prepare here. We are told also to prepare a balance sheet as at that date. So we are told to prepare a balance sheet as at that date. Now, if we are preparing a balance sheet as at that date, remember, we started by naming the name of the business, indicating the name of the business in Njoroge Traders, and then the financial statement, which is balance sheet, and then the year or that date as at 31st December 2017. It's important to know that when you're preparing a balance sheet, we use the word as at. But when it comes to trading profit and loss account, we use the word for the period ending or for the period ended. Those are the two terms we use. Now, when you're preparing a balance sheet, we start with our bookkeeping equation. What does our bookkeeping equation state? Our bookkeeping equation states that assets is equals to, this line means equal, that assets is equals to capital plus liabilities. This bookkeeping equation is very important for any student, that assets is equals to capital plus liabilities. Then we indicate the currency we are doing here. This is shillings, and this is shillings, and also the other side I've indicated shillings. Very important, the currency. And then we start with the fixed assets. So fixed assets, we have buildings from a trial balance, and then we have furniture. So now fixed assets, if fixed assets are more than one, you have more than one particular or detail. Remember, you have to add them first in the first column here, as I've indicated. You have to add these two. We just show you. You have to add these two. I mean, you have to add 450,000 and 100. You have to add this 450, and then these 180,000. And then how after underlining, I mean that I have added the two, or I've summed up the two to get 630,000. So what I get, I indicate on the right-hand side. And then I move to what I do this side. I deal with fixed assets, then I come here, deal with capital. So capital is 689,000 as we got from the trial balance. Then remember I told you adjustments on capital. What we got there, we had drawings in the trial balance. Also, we had net profit that we got from profit and loss account. The two will affect a balance sheet. And how will they affect a balance? They will affect a detail called capital. So therefore, capital is 689,000. So this capital, what are we going to do this capital? We add net profit. And then we less drawings. We less drawings. So when we less drawings, remember our drawings is 25,000 here. So we similarly what we are doing, it is 689,000 plus 94,000, which is net profit that we got from trading profit and loss account. And then we less 25,000, we get what you call new capital. So after doing that, we get 758,000. Then the other side, we remove the other side. We come to current assets. So current assets, we have debtors, and then we have bad debts, then we have cash at bank, then we have cash in hand. So now, debtors is 47,000, then amount 47,000, then bad debts 3,000, then 250,000, then cash in hand 40,000. Then stock. Someone will. It's important to note that stock. The stock that I'm using here, 50,000, is not the opening stock, but it is the closing stock. So it's important to know that closing stock is used twice. One, it will affect trading profit and loss account. How? It will be subtracted from goods available for sale to get what we call COGS. But when it comes to preparing a balance sheet, closing stock will be used as a current asset. That's why I've used it. So closing stock will be used twice. That's why I've indicated there. So after that, I get what we call 390,000 as our total current assets. I move this side and look at current liabilities. Now, current liabilities, these are debts payable within a period of 1 year, less than 1 year. So if a business has debts that it can pay within it has to service or pay within a period of 1 year, those are what you call current liabilities. They are also called short-term liabilities. And then we have long-term liabilities. These are debts payable within a period of more than 1 year. More than one, it can be 2 years, can be 3 years. So if you happen to hear a 5-year loan or 2-year loan, that is what we call a long-term liability. Now here we have bank overdraft, which is 210,000. Then we have creditors here, which is 52,000. If I happen to add the two, I get 262,000. Now we come to check if our balance sheet is balancing. And remember, if you do the right thing when preparing trading profit and loss account, there's no issue. Your balance sheet will always balance. That's why it's called a balance sheet. So here we add 630,000, which is our total fixed assets, plus 390,000, which is our total current assets. After adding that, what do we get? We get it is 1,000,000, then 20,000. That is our all total assets. And then when we move to capital plus liabilities on our right hand, we get also it is 1,000,000. That is 20,000. It means I have added 758,000, 260,000, and I got that is 1,020,000. So 1,020,000. That is our balance sheet. Finally has balance. So it's important to note that trading profit and loss account, when well prepared, it will have an effect on the balance sheet, and therefore there's no way the balance sheet will not balance if you did the right thing or you made the right entries. So that is how we prepare trading profit and loss account and eventually get what we call eventually prepare our balance sheet, which you have seen it has balanced.